Hello everyone. So for this video, we would be discussing different aspects of the first topic, which is accounting for share issues or owner's equity. So the first thing we have to discuss about is the steps for forming a company. So there are two ways we can go about forming a company. The first one is to collect the amount due in installments. So that what that would mean is the directors would decide the amount due on application when the shareholders apply for whatever how many shares they want. Second time is when the company sends out letters informing that their application was successful and they would request additional or tell them to reinvest on another share. Now the third one is when the directors call and tell the shareholders how much do they still owe. So that is for the collect amount due in installments. So overall, the company would first apply for registration. Then the registrar of companies issues a certificate of incorporation to them. Then the directors of the company must decide how much would the shareholders need to pay upon application, allotment, and during the final call. Then the company issues the shares and sends out a prospectus, which is what they offer to the shareholders to keep them safe, basically. Now the public send in cash with their application form. Then if enough application is received, the directors would be able to proceed with the share issue. Now the letters are sent informing the shareholders that their application has been successful and informing them how much would they still need to pay as allotment. Next, the shareholders actually send in the allotment money. Then the directors decide to make the final call, and the shareholders send in that final part of the payment. And that's all for the first that they could form a company. Now, there is a different process when it comes to shares that are fully paid upon application. So the same thing happens for the company. They register, they get their certificate of incorporation. However, the directors won't have to think about how much would the shareholders need to give during 3 separate times, since upon application the shares will be fully paid. So the directors would now just need to determine the time and the fair value of the shares, which will be payable again upon application. So when the company issues the shares along with putting out the prospectus, if enough applicants are received, the directors will proceed with the share issue again, the same with the last time. And the final step to that is the letters are sent to the shareholders that their application is successful, and share certificates are sent to the shareholders, so they won't have to pay 2 other times after they paid for the application of those shares.
Owner's equity represents the owner's investment in the business. It's calculated as assets minus liabilities and is also affected by a company's profits and losses. Equity can be broken down to 3 sections: contributed capital, which includes shares, as well as personal investments from the owners. Reserves, whereby an asset of the business, such as land, is revalued and found to be worth more than initially purchased for. The difference is recorded as a reserve to show the increase in value. And finally, retained earnings. This can be as When a company issues shares, these are generally in the form of ordinary shares. However, there are other types, which includes preferential shares. Where ordinary shares holders have voting rights and entitlements to dividends should the company pay out, preferential shares generally have no voting rights and can be redeemable. A preferred shareholder has higher priority over ordinary shareholders and are paid out first should the company become insolvent. They are often used as a way to
The Solvency statute relating to issue of share capital is governed under the company might elect to issue the shares at any price. However, issue price will be dependent upon market demand. There is no restriction against distribution reduction. The company meets the solvency test before permitting distribution, repurchase of share, capital reduction, and capital redemption. There are two conditions: the trading solvency test, liquidity test. The company must be able to pay its debts as we can.
These are the terms of issuing of shares. When the company makes an issue of shares known to the public, the subscriptions for the shares must be held in the trust account until such time as the shares are allotted. The shares may be issued in an installment basis, thus will require an amount to be paid on issue and a further amount to be paid at a specified further date. Next is shares are issued on an installment basis are recognized as a receivable. So if a date is not set for a collection, they cannot be recognized until there is a set date. However, if a date is set for future installments, receivable must be recognized.